Welcome back to the show. Now, before we really jump into today's conversation, I have a quick heads up, especially for the professionals tuning in.
Ah, yes, the important part.
The very important part. If you're listening to this session to, keep your credentials current, remember, there is a quiz that goes with this discussion. By taking it, you earn your CPD certificate. So keep your ears open, really engage with the ideas, and make sure you claim that certificate at the finish line.
It's always good to have that incentive right up front. And honestly, with what we're covering today, the shift in financial risk models, digital governance, earning that certificate is going to require some actual attention. This isn't just background noise today.
No, it is definitely not.
Yeah.
We are tackling what feels like a massive paradox in the South African economy. We hear it all the time, right? Small and medium enterprises, SMEs, are the engine of growth. They employ the most people, they drive innovation. But if they're the engine...
The fuel line is completely clogged.
Exactly. The fuel line is clogged. It's that classic frustration. You've got a business owner, maybe running a bakery or a logistics company.
Sure.
They're busy, they're profitable, customers love them. But they walk into a bank to get a loan for a new oven or a delivery truck, and the bank just says no.
And why?
Because they don't have a 3-year audit trail, or they don't own a building to pledge as collateral. It just feels like the whole system is broken.
I wouldn't say broken so much as outdated. What you're describing is the friction between an analog financial system and a digital business reality.
Okay.
But, and this is why we're here today, that is changing. We're witnessing a fundamental shift from, let's call them static credit scores, to what the industry is calling dynamic capability signals.
Capability signals.
Right.
I like that. It sounds much more proactive than just a credit score.
It is. It's a move from judging a business by how it has borrowed in the past to judging it by how it behaves in the present.
Okay, so we're going to explore that.
We are. We'll look at how digital identity, alternative data, and this thing called embedded finance are rewriting the rules of risk. But, and this is crucial, we also have to talk about the responsibility that comes with it.
The governance side of things.
Exactly, because when you start making decisions based on algorithms and real-time data, governance becomes probably the most important word in the room.
Okay, so let's unpack this. We have to start with the problem before we get to the solution. You mentioned this rearview mirror problem when we were prepping. What did you mean by that?
Well, just think about how a traditional credit model works. You go to a lender today, what do they ask for?
Financial statements. From last year.
Right, from the last financial year, maybe the year before that. They want to see your collateral. They're looking at historical artifacts.
So it's literally like driving a car while staring only at the rearview mirror. You can see where you've been, but you have no idea about the massive pothole or, the open road right in front of you.
Precisely. And for a stable, massive corporation, maybe that's fine. But for a growing SME or a business that operates partly in the informal sector, that history either doesn't exist or it just looks messy.
Yeah.
A business might have fantastic cash flow today, loyal customers, solid inventory management, but if their paperwork from 2 years ago is disorganized, they're locked out.
So there's a total disconnect between their actual capability and their perceived risk.
That's the disconnect, yeah.
And that's the tragedy of it, isn't it?
Yeah.
You have these viable businesses that are technically risky on paper, but completely safe in reality. So how do we fix the mirror?
We stop looking at the mirror. We start looking at alternative data. This is the paradigm shift.
Yeah.
Instead of just checking a credit bureau score, lenders are beginning to look at how the business actually operates in real time. This creates that capability signal I mentioned.
It's proof.
It's proof of resilience and discipline that just doesn't appear on a balance sheet.
I want to make this concrete for everyone listening. We have this great example from the research about a distributor in Gauteng. This story really, really clicked for me.
Yes, that case study is a perfect illustration of the shift.
So picture this. A mid-sized wholesale distributor in Gauteng. We've been trading for years. They're profitable, but they had a problem. They grew too fast.
A good problem to have, but still a problem.
Right. Their credit history looked a bit bumpy because they were stretching every single cent to buy more stock. So when they went to traditional banks for working capital, they got the cold shoulder.
The banks saw marginal risk because they didn't have the collateral.
Exactly. On paper, they looked shaky, but operationally...
Operationally, they were a machine. They had tight inventory turnover, they paid suppliers on time, they were using a digital point-of-sale system.
But the bank couldn't see any of that, right? Okay. Until the turning point. This business adopted cloud-based accounting and invoicing software. And here's where it gets really interesting. They worked with an embedded finance partner. Basically, the business owner clicked the button and said, okay, you can look at my operational data.
And that is the absolute key consent. But think about what the lender saw. Instead of some old balance sheet, they saw live signals.
Oh, kind of.
They could see transaction frequency. They could see that when stock came in, it was sold within, say, 3 days. They could see reliable customer payments coming in.
And the outcome wasn't just, okay, you get a loan.
Mm-hmm.
It was so much cooler than that. They got a dynamic facility.
That's right. The credit limit actually moved.
So when the distributor was entering their busy season, the limit automatically went up.
And when things slowed down, it adjusted back down, which is brilliant for risk management.
It's like a breathing credit limit.
That's a great way to put it. And if we connect this to the bigger picture, it shifts the entire relationship from being episodic, where you go to the bank once a year and beg for money.
Yeah, hat in hand.
To continuous oversight. The lender isn't guessing anymore. They can see if receivables are slowing down weeks before it becomes a crisis.
That sounds like a total win-win. The business gets cash when they need it, and the lender actually knows what's going on. But, and there's always a but, you can't just plug into someone's data without knowing who they are.
And that brings us to the foundation of this whole thing, identity.
Yeah.
You cannot have this sophisticated flow of data if you don't know exactly who you're dealing with. This is where digital identity comes in.
Oof, don't get me started on the old way. The dreaded KYC, know your customer. Scanning utility bills, certifying copies at the police station.
Yeah.
It's a complete nightmare.
It's incredibly high friction. In the modern context, digital identity is about securely linking the owners, the directors, and the operating entities. And it's not just a one-time check.
Right.
It allows for continuous verification. If you're going to lend money based on real-time data, you need to be damn sure that the data belongs to the entity you think it does.
So it streamlines the whole onboarding process. Instead of 3 weeks of paperwork, it's more like a secure digital handshake.
In theory, yes. But we have to talk about the data ownership aspect. This is so critical in South Africa, especially with the POBI framework, the Protection of Personal Information Act.
Right, because my immediate thought is, wait a minute, is the bank just spying on my inventory?
And that is a totally valid concern. That's why the entire model has to rely on consent-based control. It's not about stealing data. It's about the business owner saying, yes, I grant you permission to view my inventory data for this specific purpose.
Okay.
The competitive advantage for lenders going forward isn't just accessing data, it's governing it responsibly so that the business owner trusts them enough to share it in the first place.
That trust is going to be the currency of the future, isn't it? If I don't trust you, I'm not letting you anywhere near my cloud accounting.
Absolutely. Without trust, the whole system collapses right back to the old way.
Now, we mentioned embedded finance in that case study. I really want to dive a bit deeper into that because it feels like the future of banking is, well, not banking at all.
That's a fair assessment. The whole concept of embedded finance is that you don't go to the bank comes to your software.
So it lives inside the tools that SMEs are already using every day.
Exactly. Accounting platforms, point-of-sale systems, supply chain tools.
So how does that work in practice?
Well, think about the friction reduction. Let's say you're a retailer using a specific POS system. The system sees you're selling winter coats way faster than you can stock them.
Okay.
It knows you need cash to buy more. Now, instead of you having to leave the shop, drive to a bank branch, fill out a pile of forms, the POS system just pops up and says, based on your sales velocity, you're pre-approved for 50,000 Rand to buy more stock.
That's incredible. It's totally contextual. It offers the solution right at the moment the problem appears.
And for the lender, it's much safer. They aren't relying on you to tell them how business is going. They can see the sales hitting the register in real time. It provides much better early warning signals.
How so?
If they see inventory starting to pile up and sales are dropping off, they can intervene or maybe adjust credit limits months before that information would ever show up in an annual report.
It sounds almost too perfect. What's the catch? There's got to be a catch.
The catch is operational dependency. We're creating this really complex web of technology, if the platform goes down or if there's a cyber attack on the accounting software.
The credit assessment goes down with it.
Exactly. You're adding whole new layers of technical risk.
That's a scary thought. If the internet breaks, the bank breaks.
To an extent, yes. And it raises all these questions about how these systems are actually making decisions, which brings us to the professional's role in all of this.
Yeah. Yes, let's talk about the humans. We have a lot of finance professionals, listening accountants, advisors, bankers. If algorithms are doing the lending and software is doing the monitoring, what is left for the humans to do? Do we just pack up and go home?
Not at all. In fact, I would argue the human role becomes more difficult and more important. It's not just about reading a spreadsheet and calculating a ratio anymore.
So what are the new skills then? What does a data literate banker even look like?
Well, they need to understand something called data provenance.
Meaning?
Meaning knowing where the data came from. Is this cash flow data from a verified bank feed? Or is it something that's been manually entered by the user? They need to be able to interpret behavioral signals.
And I imagine they need to be the quality control for the algorithm itself.
Precisely. We have to talk about the limitations of algorithms. If we just hand over all credit decisions to an AI model, we have to remember it's just looking for patterns in data, but data doesn't always tell the whole story.
Right. An algorithm sees a drop in numbers and just thinks, risk. It doesn't read the news.
Exactly. If a model decides that businesses in a certain sector are high risk because of a dip in revenue, it might be missing crucial context. Maybe that dip was caused by a port strike or severe load-shedding external factors.
Things that have nothing to do with the business's actual capability.
Right. So the computer sees failing business, but the human sees resilient business in a really tough week.
That is the distinction.
It is. Automation doesn't replace judgment, it repositions it. We need humans to handle the exceptions. We need humans to be able to say, the model says no, but I can see the context here. This business is still viable.
That is such a great point. So that's the role of the professional now, to look at the portfolio and ask, where could real-time data help us make a better decision? And do we have the governance in place to use it safely?
You've hit the nail on the head. Governance provides that trust layer. If we don't have clear consent, if we don't have data protection, if we don't have human oversight, then SMEs simply won't participate. And if they don't participate, we don't get the data, and we are right back to the rearview mirror.
It's interesting how this also helps bridge the gap for the informal sector too. We sort of touched on this, but it's worth emphasizing.
Very much so.
A lot of businesses in South Africa are partially informal. They might not have these perfect audited financials, but they do have digital footprints.
Yes. They might use a mobile card reader for payments, but pay their suppliers in cash. Or they might use a digital ledger on their phone. Digital identity and data portability offer a pathway to bridge that gap.
So you can start to see their business activity.
We can begin to recognize their operational behavior even where formal histories are limited. It allows us to include more of these businesses in the formal economy.
So we're really moving from computer says no
to data says, let's look closer.
Or data says, let's understand the context.
That's the shift. Exactly.
I love that. It feels like we're finally treating businesses like living organisms rather than just static files in a cabinet.
It is a profound change. But we have to be careful not to get, dazzled by the technology. The tech is just the tool. The strategy is the governance.
So if you're a listener sitting in a bank or an advisory firm right now, what is the one thing you should be doing differently tomorrow morning?
I would suggest looking at your SME portfolio or your clients and asking, what operational signal am I missing? What is the one piece of real-time data, whether it's inventory turnover or invoice aging, that would tell me the real truth about this business?
Okay.
And then ask yourself, do I have the governance in place to ask for that data securely and ethically?
That's a great takeaway. Don't just ask for more documents. Ask for better signals.
And ensure you are protecting the client when you get them.
As we wrap up, it really feels like we're on the edge of a new era for South African business. We have the tools. We have the data. We just need that mindset shift.
The future of finance is already here. It's just hidden in the data. The real challenge is extracting it responsibly.
I want to leave everyone with a thought to chew on. We've talked about finance becoming invisible, embedded in our software, automated by algorithms. It just sort of fades into the background. But here's the question. As finance becomes invisible, does the banker disappear? Or does the banker actually become the most important person in the room because they're the only one who can interpret what the algorithm can't understand?
That is the provocative thought, isn't it? In a world of black box algorithms, the interpreter is king.
That's something to think about. That brings us to the end of this session. Thank you for walking us through the weeds of all this. It's been fascinating.
My pleasure. It is a really exciting space to watch.
And to our listeners, thank you for tuning in. And don't forget to take that quiz if you need your CPD certificate. We will catch you on the next one. Stay curious.